In 2008, during a global financial crisis, an anonymous creator known as Satoshi Nakamoto introduced Bitcoin as a new kind of money, one that didn't depend on banks, governments, or trust in institutions that had just failed millions of people. For years, Bitcoin lived quietly on the internet. Early users mined it on home computers, not knowing if it would ever matter. It had no real price, no media attention, and no guarantees. But slowly, that changed. As people realized Bitcoin was limited to just 21 million coins, demand began to grow. Scarcity gave it value, technology gave it credibility, and every market cycle brought more attention. Bitcoin rose, crashed, survived, and rose again. Each survival strengthened belief. By the time institutions arrived, Bitcoin was no longer a joke or an experiment. It had become a recognized asset. Banks didn't buy Bitcoin because they loved risk. They bought it because it offered exposure to a scarce, globally liquid digital asset in a world drowning in printed money. By 2025, Bitcoin reached its all-time high. Confidence was everywhere. Headlines declared victory. Many believed Bitcoin had finally secured its place as digital gold, and that's exactly where the problem began, because markets don't turn at the bottom. They turn at peak confidence. The fall of Bitcoin didn't happen because the technology failed. It happened because of fundamentals, liquidity, and human behavior. After the 2025 highs, the first pressure came from profit-taking. Long-term holders and institutions that accumulated Bitcoin at much lower prices began selling, not out of panic, but out of strategy. When supply meets slowing demand, price starts to weaken. At the same time, leverage in the market was extremely high. Traders were borrowing aggressively, betting that Bitcoin could only go up. When price dipped below key levels, liquidations began. Forced selling accelerated the downside, turning small drops into sharp moves. Then came the macroeconomic reality. Interest rates remained elevated, making cash and bonds more attractive. Risk appetite declined globally. Capital started flowing out of speculative assets and into safer ones. Bitcoin, despite its long-term narrative, still trades like a high-risk asset during uncertainty. Regulatory pressure added another layer. Governments became stricter, not necessarily banning Bitcoin, but tightening rules around custody, taxation, and compliance. That reduced short-term demand and increased caution among large investors. Institutional funds also played a major role in the decline. Many operate on models, not emotion. When Bitcoin broke important technical and risk thresholds, automatic selling kicked in. These weren't opinions. They were systems doing what they were designed to do. Bitcoin fell, not because it was useless, but because markets were correcting excess. Now, with Bitcoin trading far below its peak, many are asking the same question they always do. Is this the end? Fundamentally, nothing about Bitcoin's core has changed. The network still runs. Supply is still capped. Institutions haven't disappeared, they've become cautious. What changed is the cycle. Bitcoin is not immune to economics, liquidity, or psychology. It never was. Every major rise in its history has been followed by a painful correction, and every correction has reset expectations. This fall doesn't erase Bitcoin's purpose. It strips away illusion, the belief that price only goes up, the belief that conviction beats risk, the belief that markets reward certainty. Bitcoin isn't dead. It's being tested, the same way it always has been. And whether it rises again or not, one truth remains. Bitcoin exposed how fragile trust in traditional systems can be and how powerful belief can become when technology and scarcity meet human emotion. This isn't the end of Bitcoin. It's the part of the story where reality takes over.